Satish Ramanathan, market analyst, joins us live from Chennai. Satish, good morning. Thank you for joining us. Satish, we are bouncing back today. Do you think we have a trading bottom in place or the pain is far from over?
I think valuations are fairly attractive at this point. Market corrections have been fairly severe also. So there is scope for a trading bounce at this juncture.
Why do you think valuations are looking attractive? Because the index is still trading at about 13-14 times based on FY15 estimates. I'm not looking at FY14. So if the index is trading at 12-13 times based on FY15 estimates, that's not attractive.
If you actually decompose the index, because the index has 30 stocks or 50 stocks, you have some of the high PE stocks which are contributing to the high valuations. But if you look at some of the other stocks, they are trading at fairly attractive valuations relative to their growth prospects.
Satish, so what happens to the outperforming sectors up until today, the likes of IT, select FMCG, pharma? Is it now time to book out from those spaces because they will then underperform if banks are holding up?
I think FMCG clearly could see a bit of a correction going ahead because growth will slow down. There is a tapering effect on that sector, and you would see down trading and volume growth coming off a little bit. So there is scope for booking profits there. As regards IT and pharma, clearly they are export-oriented sectors which will be in favor, and consequently I will not pull out money from those two sectors even now.
Satish, the counter argument here is that, look, the index hasn't corrected at all. We are barely 20% off from the all-time high, and the way bond prices have moved and the way rupee has cracked, maybe equity markets are yet to capture the real pain.
They have a significant effect because if you look at in terms of a dollar basis, Indian equities are already down 30%. So to that extent, it's already reflected. So I don't know whether that there is scope for further correction from here on. So either the rupee depreciates or the markets fall, but if both happening together imply that the markets are becoming very much cheaper than what it was before.
Satish, so what else are you liking in the market right now? We've talked about IT, FMCG, pharma, banks. What about the rest of the pack? We've been seeing moves in the metals universe in bits and starts of late.
I think there is scope for a trading rally back in banks. There is a scope for trading rally in some of the cap goods sectors, especially the large ones like BHEL, L&T, which have been beaten down quite a bit. And I think there is going to be a back to the basic trading rally of 10 to 15% in these sectors.
Satish, the most important chunk for Indian markets is what global investors have done so far and what global investors could do going forward. Now here's the data for you. Foreign institutional investors, if I look at the calendar performance, they are still net buyers of about $13 billion into Indian equities. They haven't panicked. What if they start panicking? What if they start, what if global investors, they throw in the towel?
I think that's a clear risk of that happening, but that doesn't seem as likely because end of the day they are looking at longer term growth prospects, and this is plus $13 billion needs to be understood in a global context where almost $100 billion has moved into American ETFs, and the redemptions across the emerging market space has been to the extent of $8.5 to $9 billion. So there's already been redemption pressure from global emerging markets, and most of it has gone into US markets. So that trade has already played out, and I don't think that there could be a further play of that trade very much more, and therefore I feel fairly confident that the sell-off is not going to happen unless we have some political crisis or something of that sort.
I like your optimism, but the big risk in the month of September could be what US Fed could do. If US Fed starts to taper much more than what markets are betting on, that obviously will have impact on global markets and global liquidity. And typically when global liquidity has been tight, markets or economies or regions which run a strong capital account deficit, they tend to suffer.
I think that's true, and we have suffered already, and our growth rates are going to come down. At 65 or 64 to the dollar, our exports are beginning to look attractive. We are seeing green shoots in the textile space. We're going to see the pharma sector benefit quite significantly, as also the IT sector. So we have to see how the government actually induces exports, encourages exports, and trade fills the gap of $20 to $30 billion in the export markets. That said, that is really the size of the problem. If we can bridge $30 billion, then we are home.
Satish, telecom as well has been one space which has been generating some amount of positive data. Do you like anything out there?
I think telecom sector is being viewed as a quasi-consumption sector, so the PEs have been trading up. We still haven't seen the impact of 4G, LTE and what technology can do in that space. But for the time being, I think clearly the domestic players such as Idea have benefited and are growing nicely. So for a trading rally and defensive perspective, hiding money, I think it's still a decent place to keep your money there.
Satish, give me 3 large cap names where you are happy to allocate, let's say 30% of your portfolio, which is 10% of your total capital in these 3 stocks.
I would take a contrarian approach here. I would park some money in BHEL, I would park some money in L&T, I would park some money in Cipla. So these are the 3 stocks that I would be parking money at the time being.
Satish, Cipla may not be a contrarian approach. Cipla of late has been a popular stock. They have been performing. They are coming out with good set of numbers. It is an expensive stock to own.
But I would keep that, and I have got 2 contrarian stocks and 1 may be consensus, so fine, I live with that.
So two contrarian, 1 consensus. Let's understand your contrarian calls now. That's why my curiosity level is high. What makes you bullish on BHEL? I looked at BHEL Q1 numbers. They were horrible. Operating profit margins have cracked, and they've cracked to double digit. For a company which in heydays enjoyed operating profit margins of 25% plus, now has reported an OPM of about 7%.
I think BHEL is a deep cyclical, and we will have to live with the volatility in earnings there. But having said that, the currency move of 65 means that Chinese imports are going to be that much more difficult. And BHEL was beaten down because of Chinese imports, and continues to be beaten down because there is no more Chinese imports. So something has to give there, and in that argument, and also 30% of revenues for BHEL do come in as exports, and it's a play on Africa and other developing economies as well. It is a PSU stock. It's not particularly loved, but valuations seem fairly attractive, and I would probably ride through the cycle over 2 to 3 years, and I think I can make decent returns on that stock.
Let's understand L&T then. I'm being slightly stock specific here because you've given us 2 contrarian ideas. Now L&T came out with a great guidance, but markets are worried that can they really execute it? In a tough environment, do you think L&T can grow at about 15% plus, because that is the stated objective?
I think what has happened in this current crisis is that all the smaller construction companies have been squeezed, and their balance sheets have been stretched so badly that there is going to be a return of pricing discipline. So I wouldn't be surprised if L&T actually starts seeing an expansion of margins going ahead. And you would see that L&T, with its stronger balance sheet and ability to execute, would benefit from this uptrend as and when it happens.
Still not by banks?
That's the reason why banks, I have been negative till now, but I think I'm beginning to see some good value there. I would probably bet a little bit on SBI because it's fallen so sharply for a trading rally.
Okay, Satish, good having you, and thanks very much for those interesting ideas. Good to have you on the show as always.